let's start off with saying, what is Databricks Ventures and what exactly do you do?
Absolutely. So Databricks Ventures is our corporate investing program. So basically, we act as a corporate investor to focus on companies that are building integrations or working with the Databricks platform and ecosystem. And we invest alongside a traditional VC like an NEA or Andreessen as a way to bring those companies a little bit closer to our ecosystem. So it could be companies that are building a technical integration for joint customers, or that are building, part of their back end for a B2B application on Databricks. And we can often use an investment relationship as a way to drive either tighter or differentiated product integration, go-to-market messaging, and basically try to help the companies be more successful with customers and in the Databricks ecosystem more broadly.
How does Databricks Ventures work
Yeah.
with startup companies?
A whole bunch of different ways. So I guess we also have 3 different investing focus areas. One is in technology partners that build a technical integration with us. So that's so we might be helping them with, as I said, like product roadmap support to build a better integration. It may be helping connect them with product managers or field teams for customer feedback. And basically, again, helping be more successful within the technology partner program. We also work with and invest in system integrators, you're familiar with this ecosystem as a member of the Zeb team, but often an underappreciated part of a technology ecosystem, and certainly I think underappreciated by some investors. And we want to have a strong stable of system integrated partners that really understand the Databricks platform, our technology roadmap, our sales plays, so they can help customers be really successful adopting Databricks, and especially, we roll out features so rapidly, really staying on the cutting edge of what we're building. And so for those companies, we try to help them, if they're willing to bet their business on Databricks, we try to help with, the capital from a ventures investor, but also in those cases, we'll put a board observer to help support their decision-making. Those are typically folks that come from the SI organization or go-to-market. So folks that understand our customer base, our sales plays, where we're trying to drive demand or where customers need help to really, again, if these partners are willing to bet their business on Databricks, then we're trying to help them be extra successful in that regard. And then the third program that we have that helps us work with startups is something that we launched a couple months ago called the AI Accelerator. And so for the core ventures program, we focus on Series A or later, and so slightly more mature companies, but still on the growth stage. With the AI Accelerator, that's a way for us to engage even earlier with seed and pre-seed companies as they build data or AI intensive B2B applications on the Databricks platform. So that engagement is pretty hands-on. We work with hopefully 10 companies in the first year of the program, and then 15 to 20 next year if it goes to plan. And with those companies, we help them find an architecture that leverages the best parts of Databricks so they can sort of grow and scale more efficiently, really hands-on help to get that technical architecture up and running. And then we help them with go-to-market, hoping find some Databricks customers that can be design partners or early POCs. So our hope is that by the time they graduate from the accelerator program, they have a tech stack that's built on Databricks that works great. They have one or two reference customers that will go say nice things about the company and working with Databricks to their other prospective customers to help get that sales flywheel going. So it's sort of a bunch of different ways we can work with companies, from the tactical to the strategic, and sort of depends on the stage of the company and where they fit in our ecosystem.
So let's make things practical. Walk me through some of the recent acquisitions and investments that Databricks has made at a high level. How did these companies particularly stand out?
That's a great question. So we actually have a fairly consistent framework in how we think about things for both acquisitions or investments. And a lot of it comes from just the DNA of Databricks and how we think about everything, whether it's from hiring people to building products to investments or acquisitions or companies even work with on the partner side. I'd say first and foremost, we look at the quality and the caliber of the team. So are they, we have a bunch of really smart technical founders, and which is sort of required to be successful in a technical field like, data science and AI and data engineering generally. So we really look at the caliber of the team. Are they technical founders? That's a big plus. Have they seen great? So that could be where they went to school, or if they're, AI researchers, where they did research, what types of papers did they publish? Have they worked at great companies, but not just great companies? Did they help deliver great products at those companies that really made an impact? So I'd say team is always the first thing we look at when it comes to either of these decisions. Certainly on an acquisition, the cultural fit of the team is even more important than an investment when it's more an arm's length relationship, but that's certainly part and parcel of how we think about team. The second thing is really the quality of the product. That's another advantage of sort of as Databricks Ventures. I think we have an advantage because we've got so many smart people at Databricks that, build products and think about product. And we've also got really smart people in the field that are helping our customers adopt Databricks, adopt other products. They see what are the customer problems and where are the gaps in Databricks. And so we can use that as a lens for either evaluating acquisitions or investments. Like we can get, I'm not super technical, so I'm not going to be the one trying, installing a new product on my laptop and all these things. But we have, engineers and field solution architects who will do that and basically provide an opinion on the quality of the product. Which is, I think, a really valuable data point that, if you're a financial investor, it's a lot more difficult to get.
You have builders that can actually evaluate and be like, hey, is this a complicated problem to solve?
That's exactly it.
Or actually, I guess, if you're looking to invest, it's definitely then a complicated to solve. But then when you have builders that are evaluating whether you should invest or not in this, and they're builders themselves, they can appreciate, okay, I know this is a ton of work. So I know this is a hard problem.
Yes.
And
or it's not a hard problem.
Yeah, exactly. Or this they would take us X long of time or however long time to build something like this, or we can get it right now and have access to
That's
it.
right.
And not just make a wild bet as to can we build something like this internal, but you can actually have more of that proven. That's
exactly right. And the bar at Databricks is very high. So if we get feedback from product or field teams that this is a really high quality product that solves a customer pain point, and we're impressed with, the fit and finish or just the technical depth of the product, that's a really great signal for us because we've got really good engineers here. So they've got a, pretty high bar for what they look for in a third party product.
So I know we just talked about when you're making those right choices, right? What are some of the opportunities that you look back and you're like, oh, why did we pass up on this?
Yeah, I have a two-part answer to this one.
Okay.
So one is in terms of like specific examples, because we are a corporate investor and our mandate is to invest in companies that are relevant to the Databricks ecosystem and relevant to our customers, it does leave out a lot of companies that are just either really cool or really high growth, but there's no specific relationship to Databricks or our customers. So if it's an awesome company, but there's no path for a Databricks customer to use the other product alongside to help make their life easier, we probably don't have a reason to invest because we're not purely looking for financial returns. So there are a lot of companies that we could have had the chance to invest in or could have chased the investment. But when I thought about what is the point of Databricks Ventures, it's just outside that mandate. So there are definitely some of those where it's a bummer. And if we had, we have the benefit of Databricks being in the center of a lot of these ecosystem discussions, But if the fit isn't there at the moment, it's probably better for us to pass. And then maybe if you have to, wait till our next round, we get in at a higher valuation, but at least we figured out if it makes sense within our ecosystem.
You have limited resources.
We have limited
You
resources.
have problems you need to solve right now.
Yes.
You can't afford, especially when, as a company, you're not just like a general investment company.
That's right. We're not. Yeah.
You have to build on, okay, what's going to help us get to, like I was saying, what's going to help us now, and if it's going to be okay, this is going to address a problem we're going to deal with 3 years from now. Probably not the best use of your cash.
Given our focus, we've made 50 investments or so since the program started about 4 years ago. So we are pretty active, but we've got many hundreds of Databricks partners. So even 50 out of 600 or whatever the number is still a very small fraction. So you have to be very selective. And to your point, if this is a problem in 3 years, if we had a different investing strategy, maybe we would place some of those bets in forward-looking opportunities. But at the moment, we're trying to figure out what makes sense now or what makes sense in 6 to 18 months, and that's sort of the remit. Now, the second part of my answer is there's certainly companies that we didn't invest in. I'm like, wow, we really dodged a bullet, and a lot of those came from the investing program got started in the second half of 2021. So that was really the peak of the modern data stack hype cycle.
Yeah.
And, if the program were 6 months earlier, we probably would have had more opportunities to invest in companies at the tail end of that cycle. And I can remember a couple where I was like, oh man, I really wish we'd gotten in that round. And with the benefit of 3 to 4 years of hindsight, I'm glad we didn't, because the valuations weren't justified or the market went in a different direction. And that's certainly, what happens when you make investments. Some turn out well and some don't. And it's very hard to predict the future. So I would say for as many ones that I'm like, wow, that was a missed opportunity, I could probably find another that said, wow, I'm glad we didn't do that one because it wouldn't have panned out.
And honestly, I thought just occurred to me too is your philosophy, again, compared to like general investment firms too, you have less room for risk.
I'd say it's probably cuts both ways. In terms of, because we're not, I want to invest in great companies that will deliver a good financial return over time. But there are other ways we can add value to Databricks and the ecosystem other than just the financial investment. So if we invest in a company and they build a fantastic integration with Databricks and it helps 10 new customers get on board and be more successful with Databricks, we can actually take on the financial risk of the investment because we have other ways to deliver value to the company, to our customers, to the ecosystem. And the other thing is we're investing off the Databricks balance sheet. So we don't necessarily have outside investors who are expecting us to deliver a certain financial return over a fixed time period. So then we can raise another fund. In some ways we are, we're constrained because we're a company and we can't take certain risks. On the other hand, because we're not purely financial, we can take a different or broader view of how to account for value through an investment.
Yeah. But correct me if I'm wrong though, like when you're, from your perspective, again, the hope is that there's, you cannot tolerate like, hey, only 30% of our bets are going to be good. Whereas in, if you are at a dedicated pure play investment firm, you can make those bets that if 30% of them are good, they could potentially pay off for all your losses, right?
Yes.
Is that a fair statement?
But that's probably still true if you look at it from a financial sense, even in the existing Databricks Ventures portfolio. There'll be a handful that end up with extremely high valuations and being very successful, a bunch of ones that do okay, and then a handful that don't work out. So I even think within our portfolio, you'll see a similar, we've already seen, we've only been investing in 4 years, so we haven't gone through a whole cycle, but we've had a handful of exits. We've had a handful of companies raise new rounds at much higher valuations. They've gotten great market traction. So I think in general, probably the portfolio will look sort of similar from a distribution standpoint.
So I guess to need more coffee.
It's the end of the day. You need more coconut water.
I need more coconut water. Yeah. Where's my caffeine? Electrolytes, I need caffeine right now, not electrolytes. What are the top 5 mistakes people make when raising capital?
So one of the fun things is especially with the AI Accelerator, we often help the companies with their pitches and matching investors to the company. So we've both helped companies prepare the pitches, and also I definitely hear a lot of pitches in my day to day. One challenge I see is often companies or founders, especially if they're technical. Again, we look for technical founders, so they often are very focused on the technology and how fantastic the technology is. And unfortunately, I mean, and you know this from your world, customers do not buy things just because the technology is great. It has to be for a specific use case, and it delivers value. It's got to be, either boost the top line, reduce costs, and it can't just be 10% better than the incumbent. Because if you're a startup trying to displace, some product that's been in the hands of a customer for a while, you got to be 10x better.
Yeah, I was gonna say it's not good enough to just be a little bit better, because that migration from that platform to the other, or from that solution to your solution, is gonna be trickier. And at the end of the day, everyone always says that their product is better.
That's right, which may be true, but it's often enough by eye of the beholder, or it's not better enough to actually make a difference. Yeah. So that's often a problem is they get the pitches or discussions are about technical differentiation rather than customer value or cost savings, whatever it might be. Another challenge is not finding the right entry point to have the discussion, right? So is it like we built a platform that can be used for anything? That's also a very hard pitch to make. And that also is hard to, as an investor, to I'm investing in a platform without a use case, or as any use case. So we'll often advise companies to, it's great that you have a platform, and the vision may be you can do 10 things with the platform, but really start with 1 or 2 use cases they can absolutely nail and be 10x better, and lead with that, right? And then if you can get proof points from POC discussions or customer interviews about how this particular very specific thing is a real pain point and your solution's 10x better, that I think is the right way to start instead of the platform approach. And again, if you're a technical founder and you're super proud of what you built, that can often be, we can do so much more than just this one thing, but you have to start with the one thing to grow larger over time. Let's see. So that was two.
That was like 2. You can make it 2 if you have. I want to talk about whatever. You need coffee now.
Yeah, no, I guess another one is, especially at early stages, investors are betting on the team and what can the team do. So I would say just putting a logo slide, a slide of the face and where you went to school or what company you worked at, that's great. But why is your team uniquely best to go tackle this problem? Is it because you solved this problem at your prior company, or you were the person that felt the pain in particular, and therefore you're so compelled that you founded a company to go solve that pain point because you feel like no one else is doing it and you can do it. And so why are you as the founders and the broader team the right people to do it? And I think the more specific you can be with that articulation, the better the pitch will land. Because if it's just went to these schools and worked at Meta and Amazon, it's okay, great, but so did thousands of other people. So why you, and why are you the right people to tackle this?
This also applies if you're on LinkedIn and just have X Meta, X this, X right. That doesn't mean anything in itself. So you actually got to show.
Good for keyword search. That's about it.
Exactly. So on the flip side, what are the top 3 mistakes that investors make when evaluating which investments to make?
Yeah, that's often hard to know because the feedback cycle on whether you pick correctly is years and years and years. But I have some opinions. One is sort of knee-jerk pattern matching. So it's sort of the analog to like, is this the right team to solve the problem for a specific new startup? You know, VCs, it's sort of like you never got fired for choosing IBM. It's like, well, if you're at a top tier VC firm and you do the pitch to your investment committee and the founders, you know, went to Stanford and worked at company X, like, yes, okay, great. That is a safe team to back because they're highly pedigreed, but it's also true that people could have had very meaningful experience for that problem space, but didn't necessarily work at the top, you know, the two schools in the Bay Area and the three big tech companies. So I'd say that pattern matching is important, but you can't only rely on that. So I think that's often like a trap that investors can fall into. Another thing is there's like a real, I guess the polite way to describe it is like consensus investing. So it's maybe the less polite way to call it is like FOMO, right?
Yeah.
So
everyone's doing it. So
everyone's doing it.
This big name signed on to this. So
signed up. Yeah. And so it's true both based on like if the right investors backed a company at the seed stage, then it'll be perhaps easier for that same company to raise money at the A or B stage. And you know, that company with the right investors are going to get the benefit of the doubt. And it may be, in fact, that some other company has a better product or better customer traction, et cetera. I'd say another variant on that is this is often why I think you see, you know, multiple like 3, 5, 10 companies in a similar niche because, you know, every VC, they have a theme. They're like, we need AI for, you know, vertical industry X, and to get funded. And then that VC, so well, I need to find another founder to back a company in this space. And it is a real thing. I remember we did diligence on a potential investment and we talked to the lead investor and it's like, why did you pick, you know, this company? And there were a whole bunch of good reasons they could have picked this company based, you know, customer feedback. But they said, well, you know, we wanted to bet in this space and this company was like raising. It's like, that's really not a great answer. So I do think there's some of that in terms of, you know, just clustering around specific spaces because there's momentum and it, you know, could miss opportunities in other areas.
Last but not least, I know a lot of people probably will want to know the answer is why hasn't Databricks invested on PyLake? You know what PyLake is?
Is that the pie chart?
No, it's the website, the fake website that I made, like the fake okay,
I know you like pie charts. I remember that one.
So I have this very fake, fictitious product called PyLake that I say, hey, it's just gonna revolutionize the data space. So anyway, okay.
Is it based on Excel?
It takes on pie charts as the storage, make it.
We like slices. We like pie slices.
Clearly, PyLake is not in the eyes of Databricks Ventures. So A16, you know, ready whenever you are.
It's still available for funding.
Still available for funding. Yeah. Thank you so very much for your time, Andrew.
Great speaking with you. Thank you.
Thank you.